Ladies and gentlemen, welcome to the Q4 FY23 earnings conference call of GATI Limited, hosted by Dolat Capital. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touch-tone phone. I now hand the conference over to Mr. Abhishek Jain from Dolat Capital. Thank you, and over to you, sir.
Thank you, Dorian. Good evening, everyone. On behalf of Dolat Capital, I welcome you all to Q4 FY23 earnings conference call of GATI Limited. We thank the management for providing us the opportunity to host the call. From the management side, we have with us Mr. Phil, CEO, and Mr. Anish Matthew, CFO of GATI Limited. Now I hand over the call to Mr. Phil for opening remarks, followed by the question and answer session. Thank you, and over to you, sir.
Thank you, Abhishek. Good evening and a very warm welcome to everyone on our Q4 FY23 earnings conference call. We have uploaded our results and earnings presentation on the stock exchanges and the company's website, and I hope everyone had an opportunity to go through the same. As mentioned, along with me, I have Mr. Anish Matthew, the Chief Financial Officer of GATI Limited, and our investor relations team. I will now share an overview of the economy, industry, and business, after which we'll hand over the call to Anish to discuss the financial performance of the company for the quarter and year ended March 2023. We'll start with the global economy. Global economic growth in 2022 slowed down to 3.2% after recording a 6% growth in 21. The degrowth was marked by high inflation, Russia-Ukraine conflict, disruption in food and energy markets, and continued instances of COVID-19 pandemic. In 2022, central banks around the world raised interest rates in quick succession to tame inflation. U.S. Fed effected the largest cumulative rate hike in any year since 1980. On the positive front, supply chain bottlenecks started easing in 2022 due to reduced backlogs and better delivery time. The pressure from these shocks is likely to continue in 2023, with IMF predicting the global growth to slow down to 2.7% in 2023, though central banks are likely to ease interest rate tightening. While expectations of a soft landing from the base case outlook, but overall uncertainty remains high. In this backdrop, the emerging markets, though not immune to spillover effects, are likely to grow better as developed economies face the direct brunt of a slowdown. Coming to the Indian economy, despite an uncertain economic outlook, Indian economy has exhibited signs of resilience. This is a reflection of strong domestic demand with favorable demographics that act as a backbone. Strong economic growth in the first quarter of FY22-23 helped India overcome the UK to become the fifth largest economy after it recovered from COVID-19 pandemic shock. Currently available forecasts of India's real GDP growth for 23-24, including those of the RBI, broadly settle between 6 and 6.5%. This contrasts with the global GDP growth projection of just about 3%. India has emerged as the fastest growing major economy in the world and is expected to be one of the top 3 economic powers in the world over the next 10 to 15 years. The government announced Foreign Trade Policy 2023 in March, It aims at reducing transaction costs and encourage ease of doing business through process re-engineering and automation. Overall, aggregate demand conditions remain resilient for the country. Government's thrust on the infrastructure and revival of corporate investments in select sectors augur well for the economy. Investment activity in India is exhibiting buoyancy on the back of strong composite purchasing managers indices readings. Merchandise exports have risen by 6% in FY23 to an all-time high of $447.5 billion, and services exports remain strong. Overall, merchandise imports also reached an all-time high of $714.2 billion in FY23, increasing by 16.5% year-on-year. E-Waybill volumes and toll collections remain strong, reaching new highs in March 2023. RBI's monetary policy measures have resulted in headline CPI inflation declining from 7.8% in April 22 to 5.7% in March 23, with further easing expected during the year. We come to the Indian logistics industry. India is poised to be one of the top 3 economies and a global manufacturing hub in this decade. Logistics plays a pivotal role in powering the growth in EXIM and domestic trade. India improved its logistics ranking of the World Bank to rank 38, moving up 6 places. In September 22, the Prime Minister launched the National Logistics Policy, which acts as a guiding document for states, union territories seeking to formulate logistics policy. The National Logistics Policy has outlined the ambition and roadmap for the Indian logistics sector. The policy is centered around upgradation and digitization of logistics infrastructure and services. Further, with focus on bringing efficiencies in services through processes, digital systems, regulatory framework, and human resources, the policy puts marked emphasis on streamlining processes for seamless coordination and reduction in the overall logistics costs, besides incentivizing employment generation and skilling of the workforce. NLP also lays emphasis on the shift towards more energy-efficient modes of transportation and greener fuels to reduce the carbon footprint. Government's thrust on achieving best-in-class logistics costs and improving trade flows is led by flagship programs like Make in India, Prime Minister Gati Shakti, dedicated freight corridors, and production-linked incentive plans. Additionally, emergence of e-commerce provides a strong growth outlook for the sector. Industry preferences are shifting towards integrated supply chain services and other sophisticated solutions such as inventory optimization and data analytics from isolated offerings such as transportation or warehousing. The logistics outlook remains robust with government-led reforms, changing industry preferences, and newer business segments. For the financial year March 23, the express business has recorded a revenue of 1,469 crores, witnessing a growth of 18% as compared to the last year. This was accompanied by gross margin expansion by 126 basis points and EBITDA margins expanding by 176 basis points. This performance is a testament of the company's focus on volume growth and operational efficiency. With this, I would now like to share updates on initiatives undertaken under each of our pillars of growth. Sales acceleration. Despite a tough economic scenario, our sales team has been able to deliver a robust performance. This reflects our focus on service levels and customer centricity. There is continuous effort on increasing our wallet share by farming our existing pool of customers. Apart from focus on increasing wallet share, new business development is also of importance. During the year, we signed 1,669 NBDs, that is new business. We have also put in place a cost standardization and governance mechanism at product level. We have initiated sales training workshops and customer connect programs. Other growth levers for us will be the synergies between the contract logistics arm of All Cargo and cross-selling across EQ customer base. There is a strong focus on increasing sales from retail and MSME clients for improving our yield. Infrastructure. At GATI, we are developing robust physical infrastructure at strategic locations to enhance operational efficiencies like quicker transit time, less handling, and capability of processing higher loads. In an endeavor to decrease first and last mile turnaround time and cost, while simultaneously increasing booking loads, we have developed 40 new franchisees pan-India. During the year, GATI also launched hubs at Guwahati, Nagpur, and Mumbai. The Mumbai hub is spread over 1.15 lakh square feet with 61 bays and dock levelers. To enhance brand visibility, we have also branded 1,000 plus first and last mile vehicles. In the next phase of infrastructure development, we'll be setting up 4 surface transshipment hubs at Bangalore, Hyderabad, Indore, and Kolkata. We have also mandated GPS in all line haul and feeder vehicles to enhance visibility, improve performance, and optimize productivity via continuous monitoring. In order to ensure cost optimization, we have optimized vehicles and routes. We also identified areas of higher turnaround time and made necessary corrections in order to reduce the same. During the financial year, we have successfully implemented RFQ for our entire line haul routes. Coming to technology, after successful and smooth deployment of e-docket in the retail business, we have started our pilots on our credit vertical. We have initiated transformation projects to modernize GATI Enterprise Management System to state-of-the-art technology to enable business to gain market leadership. GATI, with its wide reach and network, is focusing on improving service quality by optimizing vehicles and routing loads to ensure cost optimization. We also remain committed to our ESG journey and aim to convert entire delivery fleet to electric/alternate fuels by 2025. During the year, we achieved the milestone of flying more than 100 plus electric vehicles across India for our first and last mile. We also signed an MOU with Gentari Mobility, a Petronas Group company, for 500 electric vehicles under Vehicle as a Service model. With this, I would now like to hand over the call to Mr. Anish Mathew, our CFO, for financial highlights for Quarter 4, Financial Year 23. Over to you, Anish.
Thank you, Phil. Good evening, everyone, and a very warm welcome to our Q4 FY 2023 earnings call. I'll take you through the highlights of financial results for the fourth quarter of FY 2023. I would like to start with the highlights of our express business. The quarter gone by saw weakness in initial months, followed by a strong March. The overall weakness in consumer durables and automobile sector, notwithstanding the unseasonal rains, dampened the sentiment a bit. Total tonnage handled for Q4 FY23 stood at 284,602 metric tons, as compared to 256,906 metric tons for Q4 FY22, reporting a year-on-year growth of 11%. Revenue from express business stood at rupees 356 crores in Q4 FY23, as compared to rupees 328 crores in Q4 FY22, registering a growth of 11%. Gross margin for Q4 FY23 stood at 27.1% as compared to 26.2% for Q4 FY22. EBITDA for the quarter stood at rupees 12 crore, registering a growth of 199% over Q4 FY22. I would like to highlight here that depreciation on ROU assets for financial year 2023 was rupees 45 crores and interest expenditure on lease obligation was rupees 17 crores. I would also like to mention here that we have added 530 new customers during the quarter ended March 2023, including 419 MSME accounts. For the full year, express business volume stood at 11,33,034 metric tons, registering a growth of 17% over FY22 volumes. Revenue for the full year stood at rupees 1,469 crores as compared to rupees 1,242 crores in FY 2022. Express business gross margin stood at 28% for financial year 2023 as compared to 26.6% for financial year 2022. EBITDA stood at rupees 72 crores as compared to rupees 36 crores in financial year 2022. EBITDA growth has come on the backdrop of gross profit expansion, volume uptick, and operational efficiency. Tonnage handled by surplus express business for FY23 stood at 11,23,121 metric tons as compared to 9,58,711 metric tons for FY22, registering a growth of 17%. Tonnage handled by air express business stood at 9,903 metric tons for FY23, registering a growth of 40% as compared to FY22. Our client mix for KEA, SME and retail stood at 61%, 21% and 18% respectively for the year ended March 2023. On a consolidated basis, GATI reported revenue of rupees 1,723 crores in FY23 as against rupees 1,490 crores in FY22, delivering a growth of 16%. Reported EBITDA stood at rupees 74 crores for the year ended March 2023 as against rupees 34 crores for the previous year, registering a growth of over 100%. Pre-exceptional PBT stood at rupees 4 crores as compared to a loss during the financial year 2022. I am pleased to state that for FY23, the business generated operating cash flow after working capital changes and indirect for leaves of rupees 23 crores as against negative cash flow of 23 crores in FY22. And the total debt, net of cash and cash equivalents on a consolidated basis has come down from 152 crore rupees as of March 2022 to rupees 72 crores as of March 2023. We remain confident on the growth of GATI and are dedicated to improving efficiency across the value chain. We have been consistently providing other key comparative financial performance indicators in our investor presentation. One can refer that for more details. With this, I would like to open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good evening, everyone, and thanks for giving me the opportunity. I have a couple of questions. The first one is on the realization. So if I look at the Surface Express realization, there has been a fall QOQ while volume has gone up. In the last quarter, you mentioned that, the letters have been sent to the customers for possible increase in April. Now, how do we look at it? Is it because of our endeavor to increase volume or, there is increased competitive intensity? Also, if you could highlight the market acceptance of the increase that you have discussed in the letter, that would be great. Hello? Hello?
Hello, hear me?
Yeah, I can hear you now.
Okay. So I said the letters that were sent out were basically for the new financial year starting from April, which is April 23. To answer your question, of course, in an endeavor to grow the business, the top line, and also look at the mix, these numbers will keep changing, but the whole strategy is to grow the business. As our retail or SME mix improves, the yield will also improve. Key accounts, basically, the increases that we send out via letters only happen as and when the contracts come up for renewal.
So, sir, on the whole, what kind of, on an average, uptick in realization we can expect in this year? I'm not asking for a quarter or so. I'm asking for the whole year, FY24.
So that is very difficult to predict at this point of time because it all depends on what kind of customers and what kind of volume we attract. So the mix of that will kind of look at the yield.
Okay. The second question is on the EBITDA margin. Now, in the last call, we indicated that we should look at that number of 9% by end of end of Q4 FY23. By Q2 FY24. In light of the performance in this quarter and the outlook that we see, would you like to push it ahead further?
So I will stick to what we had said at the beginning, which is we are focused on this company becoming a 3,000 crore organization by 2026 with an EBITDA of 10% plus. And we will work towards that quarter on quarter and make sure that we deliver that number.
So, but in more near term, let us say in FY24, what kind of margin should we work with? Because the margin has been quite volatile through FY23.
So all I can say is the whole focus is now on growing the top line. We spent 1.5 years since I have come into this organization on making sure that our service stands up with competition, which I can tell you that in the last 4 months, we have now brought our service to a level. Now it is for us to grow the top line. And as previously stated by us, as we grow the top line, we are going to leverage our fixed costs, both of S&OP. So basically, that is the whole leverage game that we will have to play to get the margins up and going.
Okay, fair enough, sir. Thanks and all the best.
Thank you.
Thank you. We have the next question from the line of Alok Deora from Motilal Oswal Financial Services. Please go ahead.
Yeah, good evening, sir. Just a question related to the previous questions. So, sir, I just wanted to understand how do we see these margins moving now? Because initially, few quarters back, we had a 9% sort of a margin guidance for end of this year, and now in the last, I think, call, we had mentioned about that being shifted by 2 quarters. But right now, whatever margin performance we see, what's the realistic guidance we have for a 10% sort of a margins? Because, and some roadmap on that, because since many quarters we are in this kind of a range, just some update on that if you can provide.
So I just answered this question, exactly the same question by your predecessor. Do you want me to repeat the answer or you heard my answer?
The line for the current participant in the queue seems to have disconnected, sir. Would you like to proceed with answering the question, or should we move on to the next participant?
No, I answered the same question the first time around.
All right. We will proceed with the next question, which will be from the line of Aman Veej from Astute Investment Management. Please go ahead.
Good evening, sir. My question is on the industry growth. So, in terms of volumes, how do you see this year planning out for the industry, FY24? And as for us also, what kind of volume growth are we targeting for this year?
So we are basically looking at the logistics industry growing at 9% this year, and express logistics generally grows at about 1.5 times the logistics industry growth. So I would say anywhere between 13 to 14% should be the express logistics industry. And as an organization that has rebuilt itself over the last 2-3 years, our growth should be greater than that.
Sure. So this number you're talking about is volume or value?
I'm talking in terms of both volume and value.
Okay. My second question is, sir, for, say, April month, e-way bill had grown at, say, 15% plus. And the release you had sent was, our growth was mostly flattish. So, any reason, was it an aberration, or is e-way bill the right way to look at the growth of the industry and our company as well? If you can talk about the same.
So I haven't really looked at the April month, but March month e-way bills really went up, and so did our top line for the month of March after a slowdown in the months of January and February. In fact, the industry, express industry itself for this April was down, and we were with the industry. But with the e-way bill, I haven't compared it for April.
Okay. Because e-way bills were up by almost 12 to 15% year on year, April versus April. While our press release had talked about flattish, so I just wanted your take. So has the things improved, or is it still a little tough in May as well?
May month has been far better than April.
Sure, sir. These were the questions for now. Thank you.
Thank you. Ladies and gentlemen, we request you to please restrict your questions to 2 questions per participant. For follow-up questions, you may rejoin the queue. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
लाइन पर रहो. आप जिस व्यक्ति से बात कर रहे हैं.
We will proceed with the next question, which will be from the line of Abhijit Mitra from Ainos Alpha Investment Management. Please go ahead.
Yeah, thanks for taking my question. So I was just trying to, make out 2 numbers. First of all, what are the, reasons, top 3 reasons as per you for your, gross margin and EBITDA margin to decline, significantly in this quarter? That's point number 1, question number 1. Second question is that over last 3-4 quarters, they also have been sort of, making a point on your, depreciation staying flat, but the depreciation keeps moving up. So even this quarter also it has moved up by almost 20% QOQ. So what used to be a 10 crore run rate quarterly is almost 18 crore run rate quarterly. So if you can also sort of, suggest your new expectations of depreciation moving ahead, that would be great.
Anish, you would like to take this call?
Yeah, on the depreciation part, actually. So for this quarter, there is a one-off charge to the tune of around 3 crore rupees on account of change in estimate with respect to, some commercial vehicles which we were having. So we used to have commercial vehicles, so we decided not to kind of, own the commercial vehicles. So we terminated the lease agreement after with the financier. So that resulted in kind of, accelerated depreciation of around 3 crore rupees for this quarter. So this will be one-off. So going forward, we won't be having this charge.
So 15 crore is the most stable run rate on a quarterly basis.
Yes, right. Yeah.
Got it. Thanks. And my first question, if you sort of just list out the factors which led to this drop in margins.
So, as far as we are concerned, the margin of quarter 4 FY23 has increased over quarter 4 of FY22. Your question was more to do quarter over quarter, right?
Yes.
So, like I always said, the margin gets leveraged because of volume. And our volume fell in the Jan and Feb months tremendously, although in March there was a big recovery. But for a period, if the volumes fall, the margins tend to also fall along with that.
Okay, so just conceptually, just to understand the point a bit better. So sequentially, the drop in volumes is only 1%, but because of the timing of that volume drop, you are saying that cost incidence is higher. I mean, is this the way one should look at the business going forward as well? As in, there will be months where volumes might be flat, and that would create such a huge incidence on your overall margins that the margins drop. In a way, irreparably, even if volumes in the subsequent months pick up. How to sort of conceptually understand this?
Yeah, so there is a certain fixed cost to any business. So if the volume drops below the average fixed cost that we need to leverage through our top line, then of course the margin will drop.
Got it. So your March margins would be significantly higher than your Jan and Feb margins. Is that the way to look at it?
Yes.
Okay. Got it. I have more questions. I'll come back in the queue. Thanks.
Thank you. We have the next question from the line of Rajat Sethia from iThought PMS. Please go ahead.
Hi, thanks for the opportunity. Sir, in terms of our volumes, how much of the volumes would be coming in from the new hubs that we have built so far as a percentage of the total tonnage in the surface business?
So, GATI works on a zonal structure, and if you look at our zones, the main hubs for North Zone is in Farrukhnagar, Delhi, and the main hub for West Zone is in Bombay. I would say that if we look at the volumes running through these two hubs itself would be about 20% of our total country's volume. And therefore, including the other two which we have completed in the last year, which is Guwahati and Nagpur, there would be about anywhere between 22 to 25% volume running through these hubs.
Understood, sir. Thanks. The second question is about the historic baggage that you referred to in the last call. So how exactly is it affecting our company? In terms of gross margins, we are already near the ideal gross margins for a surface logistics business, which is around 30%. We are just 2% away from that. However, we are getting hit in the EBITDA. So what exactly, in what way is it hurting us, the historic baggage? What exactly was it, if you can elaborate?
So basically, the gross margins, as far as we are concerned at GATI, the ideal gross margin that we would look at would be anywhere between 30 to 32%. And therefore, these deductions have still a direct hit on our gross margin. This was basically a period where we had taken up to clean up the past. I think gradually we'll be putting that behind us, and we will see this business growing at 29% in the very near future.
Sir, I mean, if there was a pricing issue historically, then that would reflect in the gross margins. but we are getting hit below gross margin. So what exactly is that issue, if you can help us understand?
So there are various issues that we have, and when we look at creating what we call ECLM provisions in our books, which is below the gross margin, those get created when the collections do not come in on time, and collections do not come in on time when there are discrepancies with the customer. So it's a multiple effect that happens to the P&L.
So what percentage of the cost or as a percentage of revenue, how much cost would you attribute to such historic actions?
So there is no fixed percentage. It moves from month to month, but it was pretty substantial in lieu of the revenue that we are generating on a monthly basis, and therefore it did affect both gross margin as well as EBITDA.
So, I think I can just kind of add a flyer, Phil, if you can.
Yeah.
Yeah, so I think the total ECL provision which we have made for this financial year is almost like 24 CR. That's substantially, very, very high number. And, in comparison to this number, last year it was 15 crore rupees. So that's basically based on the aging, And if you look at the quarter four, all the efforts which are kind of putting into collection, has kind of started yielding the results. So, we have seen substantial reduction in ECL provision for this quarter. However, we also saw a slight increase in the deductions, okay, which is what Phil was kind of talking. That kind of sits in the top line because while we have made a provision, when you do a credit note, that would need to get adjusted in the top line. So while we saw a decline in the top line, partly driven by the credit note issued, and we have also seen a softening of the ECL provision, which is coming in the better line. But net, if you look at for the year as a whole, 24 years, it's a huge, substantial amount of, for us to kind of have and, provision the books, okay. As we kind of, putting all the efforts, and I'm sure, okay, this will come in as, as a reversal in the coming quarters, or maybe in the next financial year.
So this is the only hit because of the past actions, or there is something else as well?
Can you just repeat? I could not hear you properly.
Is this the only hit that we have taken in the P&L this year because of the legacy problems, or there was something else also?
Yeah. We are carrying a good amount of provision in the books, as a reserve. So I wouldn't say reserve. I would say there's a provision as per Ind AS accounting standards. So, as we kind of, bring down the DSO, this will kind of DSO bringing down DSO would mean, okay, you want to kind of collect the money. And that will kind of, itself will unwind, the provision which you're carrying in the books.
Sure. Thanks so much. I'll get back in the queue. Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. You may rejoin the question queue for follow-up questions. The next question is from the line of Nimish Shah from MK Investment Managers. Please go ahead.
Thanks for this opportunity. So I had a question on the realizations for this quarter. So if I have to just compare sequentially the realization, there was a drop of about 5 to 6%. So can you just throw some light? What was the reason behind this?
So when you say realization, are you meaning the yield?
Yeah, yield per ton.
So yield in our business basically has 2-3 connotations. One is a mix of the business, which basically means that if your key account business grows faster than your SME or retail business, then your yield will fall. it also depends upon the mix of the lanes in which we get our business. So if the business has longer lanes, then the yield is higher. For example, if I'm picking up load from Bombay to Guwahati, vis-a-vis picking up load from Bombay to Pune, the yield will be higher for that business. So the combination of this kind of moves the yield.
So there were no discounts as such during this quarter?
No, not really, because most of our business, as you know, is coming from key and SME customers who are contracted. So therefore, whatever it is contracted is what you get from your customer.
Right. So can you share some data as to how much as a percentage of revenue will be from key customers and overall how much will be contracted?
So our customer mix is 61% coming from the large key accounts, 18% coming from retail customers, and the balance 21-22% coming from SME. So besides the retail, both SME and large key accounts will be contracted.
Understood. Yeah, that's it from my side. Thank you.
Thank you. The next question is from the line of Dwanil Desai from Total Capital. Please go ahead.
Hi, good afternoon, everyone. So my first question is, I think Anish mentioned about this ECLM provision of 24 crore this year, and it was 15 crore last year. So two questions on that. One is it sitting on the other expenses currently? And going forward, our normalized ECLM, is it around 15 crores, or would it be even much lower than that? If you can highlight on that.
Yeah. On the first question, it is forming part of the other expenditure. And your second question, it would be much lower. It cannot be 15 crore rupees. It would be much, much lower. I can't tell a percentage at this point in time, but I think far, far, far lower than what we are trending right now.
So is it safe to assume that as we go to FY24, most of the things which had to go into ECLM has been accounted for, and the deduction and everything, largely done, maybe a quarter more? Is that the right way to look at it, or how do you guys look at it?
Yeah. I would say the quality of the debtors have kind of, definitely improved, actually, but still, as we try and settle the matters, we might see some impact coming in the top line, and that would kind of, have an unwinding effect as on ECL provision. So we don't expect to see, this much of provisioning coming in the next financial year.
And just one.
Sorry to interrupt. We request you to please rejoin the queue for follow-up questions. The next question is from the line of Diresh from WO Group. Please go ahead.
Yeah, hi, I'm Diresh from White. I just have a basic question. So in this slide 6, my bad. So this pie chart shows the client mix. So KEA, MSME, I understand. What is KEA, which is a larger pie?
That's basically our key accounts, which are our large accounts.
Large accounts, okay. And retail, what would we classify as retail?
So retail customers are those which give on cash and carry basis.
Okay, but they'll still be institutional, right? It's not that you don't have a courier business like retail. If I want to send something, can I go to GATI and send it?
It's a B2C business. But these are basically small-time entrepreneurs who will ship maybe once a week or maybe at the most twice a week kind of shipment.
Okay, understood. And the business which you show as Surface Express, this is, you don't do door-to-door delivery, right? To, let's say, somebody's house, individual customer's house. This is part truckload express delivery, right? This is not the business that, let's say, a delivery does for Amazon or Flipkart.
This is B2B business, which means that our end delivery will be at either a distributor or a stockist or even a company.
Okay.
Not B2B.
For air, understood. And for Air Express, you will take the belly cargo of the private air, of the passenger airlines, or do you have some arrangement with some other cargo airliners?
No. It's all of it is through common carriage. The belly.
Common carriage. Okay. And the credit loss that you booked in other expense, this will be for the MSME accounts, I'm assuming, right? Which is 20% of your money.
Sorry, I did not get that question.
So in the other expense, there is some bad debt write-off or something, right? That is higher this quarter, which if you see large accounts, I'm assuming they are paying on time. Retail is cash and carry, you mentioned. So the 20% of the business, which is MSME, some of those accounts is where you would have taken a write-off, right?
No, so basically, if you're talking about the ECLM provision, which Anish just spoke about, it would be for any category of customer. If there is, for example, a dispute with even a key account, then the dispute needs to get resolved. And while it is resolved, your outstanding moves from one bucket to the other, and that's how an ECLM provision gets created.
Understood. Okay. Thank you, sir, for taking the question.
Thank you. The next question is from the line of Rohit Suresh from Samatva Investments. Please go ahead.
Good evening. Thank you for the opportunity. So my first question was, could you highlight the P&L impact, so in terms of rent or other operating expenses for the hubs that we have put up?
Anish, you want to take that?
No. Can you just repeat the question? You're talking about the operating expenditure for all the hubs.
Yeah, the hubs. Yeah.
Okay. So when you say operating expenditures, you're talking about the rental expenditure plus other running. Yeah. So I don't have a data right now ready with me. I think the major expenditure for any hub operation actually would be the rental, which we pay because we don't own any of the warehouses. We kind of take it on lease. And that lease cost would be the one which is coming in as a major item, and that is forming part of the other expenditure. And the rental actually would be, in the range of around, anywhere between 18 rupees per square feet to 25 rupees per square feet, depending upon, the kind of facilities, or amenities actually which we have built in that particular warehouse.
Got it. Okay. Sir, and my second question was that based on our target of around reaching 3,000 crores by FY26, what kind of volumes are we actually looking at to reach that 3,000 crores? Hello.
Hello, can you hear me?
Yeah. Yes.
Yeah. So if you look at our number as of 31st March 23, if we were to reach the 3,000 crore run rate by 26, we would need a CAGR of about 18 to 20%.
Got it. Sir, and my last question was on the Faruk Nagar hub being the first new hub that we put up around 1.5 years back. So in terms of volumes, how has it been like in the past 1.5 years? How has it grown? If you could give some your views or some numbers, that would be very good.
So we have given that in our investor presentation slide. I can read out from there if you want.
No, okay, fine. I may have missed it out. Thank you so much.
Thank you.
Thank you. The next question is from the line of Siddhant Sanjay Shah from KBS. Please go ahead.
Hi, thanks for taking my question. I think the communication to investors has been to focus on the SME segment over the next couple of years, and that has been identified as the growth engine to really drive us to that path to profitability, but we haven't really seen any meaningful change in mix between KEA, SME, and retail. And I believe in a recent article that I read in the newspaper, we plan on doubling the SME mix. So can you throw some light on some strategic initiatives we're taking on increasing this number without it really increasing the KEA account?
So, first of all, you have to understand that if I'm growing my KEA business, I have to grow my SME business many-fold to even retain the percentage today, right? So if I am at 61-22, if I'm growing my KEA and to retain 22, I have to grow my SME many-fold. So I just want that one point to be appreciated. Otherwise, the SME percentage will actually degrow. The second thing is, how we are doing this is 2-3 different ways. One is we want to grow our franchisees. We have grown around 40 franchisees in the last year, and we are looking at another 100 franchisees this year. Franchisees generally are located closer to the SME customer. They speak their language, and they know where these businesses are and enable us to get the business. Secondly, we are also partnering with the India SME Chamber of Commerce to become their logistics knowledge partners, and we are attending a lot of conferences and seminars that they set up where a lot of the SMEs get represented and they understand what benefit we can give them by way of our network. So these are some of the initiatives that we are taking besides digital marketing that we do direct to the SME clusters in various parts of India.
Got it. Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Sir, if I'm not wrong, in one of your earlier calls, you guided for some price hike that would be taken from April 1. I just wanted to know if it has come through.
Sorry, I could not hear you properly.
Hello?
Yes.
Yeah. Sir, if I'm not wrong, you had, guided in one of the earlier calls that there will be some hike that would be taken from April 1st. I just wanted to know if the hike has come through.
So it is a continuous process. We do send out letters to all our customers, and then of course the customers want to basically meet up and talk to us. The process is on, and I'm sure we get some benefit out of it.
Oh, okay. More or less, if I'm not wrong, you had said like 8% price hike in Q3 call. So that's why I'm...
That's the percentage letters that we sent out to the customer.
Okay, fair enough. My second question is on the gross margin side. So if I'm not wrong, we have ended the year with 28% gross margins. With the new hubs kicking in, with all, would we see some improvement coming in FY24? Somewhere near 30-31%.
So it's continuous endeavor to increase the gross margin. Also, keep in mind that the gross margin that we've ended the year with is in spite of all the deductions that we have taken. So basically, gross margin does get affected when you have deductions because your cost remains the same, but your top line reduces. So definitely, it's a continuous effort for us to increase the gross margin.
Well, sir. Thank you. All the best.
Thank you. The next question is from the line of Abhijit Mitra from ANEOS Alpha Investment Management. Please go ahead.
Yeah, thanks for taking my question again. Just to sort of hop on first two questions. I think initially the ability of the confidence to guide for certain margins in 24 and not being able to do that now, is it because of some delay in negotiations with the legacy contracts that you see that you're probably hoping to sort of resolve in the next couple of quarters, but they're dragging along for a bit longer than what you initially expected? Is that the reason to be not able to lay out a roadmap towards the 10% margins right now? Is that the way to look at it?
No, there is no single reason. I still stick to my 3,000 2026 with a percent margin number. It is just that as you take over an organization that has been sold off for various reasons and you kind of try to put it back again and bring it back to where it was, a lot of things come up, and so we are working through all of them, and we are showing continuous improvement, and that will continue.
Okay, got it. Thanks. That's all from me.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question for today. I would now like to hand the conference over to the management for the closing comments. Over to you, sir.
So thank you for being on the call. If you have any further questions, you could always refer them to our investor relations team at All Cargo Group. Thank you once again for attending the call.
Thank you. On behalf of Dolat Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect.